Hi, John. How are you?
Good morning, Shannon. How you doing today?
Good. So I'm Shannon Aronson with Keller Williams Realty. This is my favorite mortgage guy, Jon Lamkin.
Thank you.
John is with Guaranteed Rate, and you really are one of those people that everyone knows you. So congratulations on pulling that off.
I don't know if that's good or bad.
A little bit of each, but I know whenever I hear people talking about mortgages around here in this area, your name comes up really as being the cream of the crop. So thanks for all the help you've given me with all of my clients. I have to laugh. About a week ago, Jon Lamkin called me more excited than I've ever heard him about anything that's not sports related. So I took his call and gave a listen, and he was really excited to tell me about this really great mortgage program called the New Jersey Down Payment Assistance Program. John, why don't you talk a little bit about what in the heck is so exciting about the New Jersey Down Payment Assistance Program?
So about a month ago, I was notified internally that due to Hurricane Sandy, there was a lot of funds that were left over. So the state has now allocated about $3 million left for first-time home buyers to provide them up to $16,000 of down payment assistance program, which could be used for their down payment and or their closing costs.
So tell me a little more about what's so great about that. What do people need to do to qualify, and what will the repayment on that be?
Okay, so a couple specifics is the program is only designed for 6 counties in New Jersey. The 3 counties that Shannon and I work out of would be Essex, Union, and Passaic counties. The program is designed for first-time home buyers. So specifically first-time home buyers. There's income restrictions, meaning they only want to use the program for people that need it. So if your family is earning $131,000 or less, that qualifies them for the program. They do have to have a minimum 620 credit score, which is that's pretty feasible. That's not a significantly high score, but they're really looking to try to accommodate first-time home buyers that make good income, but just maybe haven't had the ability to save as much as they would have liked to buy their first home.
So, John, there are a few people that are coming to my mind now that we've started fleshing this out a little bit. Who are you seeing take advantage of this program?
So since we've been talking to all our real estate partners about it, the first type of people we're starting to see is the millenniums. These are the kids that are just out of college. They might be renting in Hoboken or Jersey City, paying $3,000-4,000 a month, but they haven't had the ability to save anything. So I had one scenario where a realtor referred her son that was potentially looking to buy a 2-family. He didn't really have that much money saved, but this $16,000 would get him over the hump, because a lot of times people have the down payment money, but they forget about the closing costs. And closing costs,
they add up, right?
Yeah, I mean in New Jersey, title insurance is very expensive. The attorneys in New Jersey are going to charge anywhere from $1,000 to $1,500. So at the end of the day, I always tell people that's like another 2.5% to 3% of the total purchase price. Okay,
so you said somebody needs to be a first-time home buyer.
Yep.
They need to have a credit score of 620.
Correct.
They need to earn less than, do you think you said 131?
Yep.
Okay. Now, typically somebody like that, in addition to what they can get through this program, how much money is somebody like that going to need to have stockpiled to get a house? Like, let's take maybe a $350,000 house, for instance.
Okay. So the nice thing about the program is the client can get any type of mortgage they want.
Okay.
We can put them in a conventional mortgage, we can put them in an FHA mortgage, we can put them in a VA mortgage. So that's the nice part. So they're not restricted just to a certain type of mortgage.
Okay.
But on a $350,000 house, you'd always like someone to put down 20%, which would be $70,000. But that might not be realistic.
Okay.
So let's say they only have $35,000. So that's 10% down. But they don't even have any more money for closing costs. You take now that $16,500 and we use that for a portion of the closing costs and a portion of the down payment. So now they're not depleting their entire $35,000. Now instead of having $35,000, they have $51,000.
Okay.
So they have now this extra money where they put the $35,000 down, they use the closing cost, and then they have a couple bucks left. So when they get in the house, they can buy some furniture.
They got to make a Home Depot run
That's
when
right.
they get there, right?
Exactly.
It always amazes me. The first thing you need to buy when you move into a home are the garbage cans for outside, and they're very expensive.
I haven't bought one in a while. But.
You haven't? Okay. So I think you said it's capped at $16,000. Is that correct?
Yep.
Talk me through another scenario. I'm thinking of some of the recent college graduates that I know, friends, sons and daughters of some of my kids who are just starting out, and I'm sure that they would be earning less than the 131. They may have saved up a couple of bucks, but probably not enough for the 20% or even the 10% that you mentioned. I know sometimes, John, we've done deals where you've helped people get in with even less than that, and maybe an FHA loan.
Yeah, they could go as little as 3.5% down. So if you were to buy a home for say $300,000, you'd only need 10.5 for the down payment, and then if the closing costs are say another $10,000, that's like $20,000.
Okay.
So conceivably, somebody could buy like a $300,000 house with $4,000, and then use the other 16 to make up the difference.
Now, in order for somebody to qualify for, let's say, for instance, an FHA loan where they really do put down a small amount, talk to me about who would qualify for that, or what might make someone not qualify for that.
Well, with an FHA loan, there's like a preconceived notion that you could be overqualified, which really isn't the case. I mean, anybody can get an FHA loan. There's both positive and negative. The positive in an FHA loan is the interest rate is typically lower, and it's not credit sensitive. Where a conforming mortgage, your rate's going to be dictated by how high your credit score is. With an FHA loan, as long as you're over 620, you could have a 620 or a 780. It's going to be the same rate.
Okay.
But then on the flip side, one of the downsides of an FHA loan is they do have to pay the upfront mortgage insurance premium, which is 1.75. So it's an extra amount that gets added into the loan. It's being financed over 30 years, so it's really not that big of a deal. But it will give somebody the ability to buy a house, today versus waiting 3 years, where there's going to be a lot of appreciation that we're seeing, in home sales.
So again, just to recap for anybody just joining us, this is Jon Lamkin with Guaranteed Rate. We're here today to talk both about mortgages in general and also the New Jersey Down Payment Assistance Program. I'm Shannon Aronson, local realtor with Keller Williams, working predominantly in Morris, Essex, and Union counties. Now, John, you've told us that somebody needs to earn less than a certain amount. They need to have reasonable credit, albeit not off the charts, capped at $16,000. Tell us what happens with that $16,000. What is the repayment on that $16,000?
So the beauty of it is when they buy the house, they don't have to pay any interest whatsoever on the $16,000. The $16,000 is sitting. It's attached to the house, and a simple term is it's called a silent second. And what that means is that there is a lien on the property, but if the homeowner owns the home for 5 years, it's completely forgiven. So they never pay interest.
That's crazy.
Yeah. So one of the conversations I had with somebody the other day, they said, well, I'm thinking of buying this place, maybe live there 3 or 4 years, and then rent it out. And that's a very, very common, scenario. We see a lot of people that are, buying homes right outside the city in Hoboken, Jersey City, Weehawken, that area.
Mm-hmm.
They buy them, they live in there 3 to 5 years, they have a kid or two, and boom, it's time to move to the suburbs. And so as long as they keep the property for 5 years, they don't have to pay it back.
And John, this is one of my favorite topics, but what a great way for somebody to get started building their wealth through investment property. If they can get in on their first property with a very small amount of money down, plan to then start saving money already for their second down payment on their second home.
Yep.
Then when it's time to move out, keep that as rental income, even if it was just a break even.
Yep.
Let somebody else pay down their mortgage for 15, 18, 20 years. By then, that rental income is now going to basically finance somebody's college education.
No, absolutely.
So I just can't think of many better things for somebody to do who's young and wanting to start to build wealth in real estate. I love to tell my clients that if you want to buy $300,000 worth of stock, usually you need to come up with $300,000. In this case, if we've got somebody who wants to buy a $300,000 eventual investment property, you're telling me potentially with an FHA loan they could get in for about 3.5%.
Correct. It does have to be a primary residence initially.
For a time,
For
right?
a time, correct, yeah.
With an FHA, if somebody does move out in a few years?
Well, technically, when you have an FHA loan, you do have to notify the lender if you do move out. But if you're paying the mortgage every single month, there's typically not an issue.
Okay. Is there a period of time at which it's actually just okay to move out, or that's
specific? With an FHA, it's really case specific. We do see a lot of people that have FHA loans that they bought it as a primary residence, they moved in within 60 days, they lived in the home for an extended period of time, and if they move out, and let's say they couldn't have the ability to refinance it at that point, they could refinance the loan. So you
Okay.
can refinance the mortgage while you're in it. So if you build up some equity, you might want to refinance it when you move out because you can get rid of the PMI.
Okay.
If you built up the equity, and then you have it as an investment property, you still have that 16.5 that you don't have to worry about because you own it for 5 years, and then the person goes out and buys another home and could get an FHA loan or a conventional loan, whatever they want.
Okay. And with the New Jersey Down Payment Assistance Program, that's okay if it's a single family home or a multifamily home? Is that correct?
Yep, single family, 2-family, and condos.
Okay. This has been a really great program. Thanks so much for filling us in about that.
No, thank you.
Before I let you go, of course you know that in my life and in your life, every day people are asking us about rates at the moment. So can you just give us a little bit of a recap in the broader markets that we work with, where rates are right now, where are you expecting them to go, and what's important for people to know?
Well, first off, I wish I had a crystal ball to let you know where they're going to go. It's been a crazy, crazy year, especially since the election. This morning I just looked at something to get an idea of where rates were last August and compared to today.
Mm-hmm.
So we're about a quarter point higher. You know, right now we're like 3.75 on a 30-year fixed, you know, for certain scenarios, where last year we were like low 3.5. As most people know, after the election, you know, rates skyrocketed to like 4.25. People were panicking. I know people that I work with, everybody thought rates were going to be 4.5 to 4.75 at this point. I tell everybody right now we're on borrowed time because it's only a matter of time that long-term interest rates are going to go up. So it's still an amazing opportunity for people to buy. We do see a lot of buyers out there. You know, unfortunately the inventory isn't as high as we'd like. But I mean, rates are still super, super low. Home ownership's all-time affordability. And you know, it's a good time to be in our space.
Yeah, it has been a great time for mortgages for quite a while.
Yes, it is.
John, I can't thank you enough for all the great service you provide to our clients. If anybody has questions about mortgages that they want to talk to John about, you can go ahead and send in a comment or message me on Facebook, and I'll be sure and get the information to John. Thanks again. Next time there's something else exciting in the mortgage world, I hope to get another phone call.
Definitely will. Thank you very much for having me.
Thanks.
Have a nice day, everybody.